So happy New Year, everyone. I haven't. This is an update video for my stock market stuff. So first I'll show my holdings. So Aritzia ATZ has a earnings report coming up in January, so that's why I have I bought 2 straddles for ATZ. And so BTE, I'm still holding BTE because it's the price dropped a lot, so like obviously I can't sell it. So I just have to wait for the price to go back up. So that's all there is to that. And I bought some straddles for BTE because I'm expecting some sort of major price change. Maybe not, in the short term, but these are 6-month calls, so I think in 6 months there should be some significant price movement. And then BlackBerry, so this was from because the BlackBerry earnings report was in I think it was around Christmas, I'm not sure, but so I bought some straddles for BlackBerry, and then I sold the puts because the price dropped a lot, and I'm not sure what because it takes a while to load. That's why I don't really want to but yeah, right now it's at 470, so it dropped $1 from when I bought it, so that's why I sold the puts. And then Bitfarm, Bitfarm is very volatile, so I bought the stock and I sold call options on it, and it dropped, so I think it's gonna rise back up, so whatever, I have the stock so I can keep holding it. And then WEED, obviously, so this stock, it did a 10-to-1 reverse stock split. So before it was under $1, and now it's at $6. But anyway, so what happened after the reverse stock split? And I don't even know what this is. So obviously before I sold covered calls on WEED. So that was. But the thing is, now 100 shares of WEED is 10 shares. So then these turn into non-standard option contracts. So then I don't really know. So it's kind of confusing. Like it has like doesn't really have like a stable price for these non-standard options, and I'm probably gonna call my bank about it and just ask what what exactly happened after the reverse stock split. So then what happens to the call option? So it's just anyways, shouldn't pay too much attention to this. It's just because the stock, the number of shares changed from 10-to-1, so then the call option becomes non-standard. And then CLS, so this is a straddle, and I bought a long call on CLS for 6 months because because I think that in the long run it will go up. think I'm probably right. And then CCA, so I have CCA because of the earnings report is coming up in January. So that's why I bought 2 straddles, because I think on the earnings report there's going to be some price jumping. And so Dollarama, obviously, so I did a straddle on Dollarama before, and I made some money selling the put, but obviously the call is worthless, so I didn't. And I bought another straddle afterwards. This is a 6-month straddle, so I sold the call because it rose, but the put I'm still holding it. And FM, obviously, so FM dropped a lot after I bought it, but I sold a bunch of call options for it, so I think I broke even. But obviously I can't sell the stock because it's $3 lower than I bought it for, so I'm just gonna keep holding that. And then so HUT is, again, it's a very volatile stock, so I bought it, but it dropped. I thought it was gonna rise, but it dropped, so I'm gonna hold it because I think it's gonna rise. So I'm just gonna hold it. I sold some covered calls on it. I actually did a roll. I actually rolled the HUT call because before it was at 22, and then it dropped to 18. So then I sold the cover call. I sold the calls at 22 and bought it. I bought back at 22 and then I sold at 18. So I already made money flipping the 22 call. So and then IVN, it's been sort of like a sideways. It hasn't been rising a lot. Like it sort of went up to 13 and then sort of stayed around 13. So the covered calls, so so I think I could sell IVN, but the problem is the bid-ask spread. So if the ask price was $5.60, then I would definitely exit out of the IVN covered calls. But the problem is the ask is usually at 6 something, 670. So if I exit at that, then I get a net loss, so I can't do that. But if I can buy the callback for $5.60 and then sell the stock for $12.80, then it's a net profit. So it's just because it's like I lose $1.20 from the call and I make $1.70 from the stock, so net I gain 50 cents. But yeah, I couldn't. I'm not able to buy back the calls for a good price because of the bid-ask spread. That's the main problem. And then MRU has a earnings report coming out in January, so that's why I'm holding it, because there should be a significant price change at the earnings report. And then NXE, so these NXE calls, I've just been holding them because I don't know if it's gonna finish in the money. I don't know when I should sell them. If I sell them now, I think, I don't know, it's already January, so I don't know if I should sell them before the expiry or hope that it finishes in the money. I'm not sure. And obviously, so Shopify. So this is a strangle on Shopify. The 115 on the leg 1 and 84 on leg 2. And the straddle as well. I think the earnings report for Shopify is sometime in February. I'm not sure, but so I'm not sure if I should sell the strangle now for a loss or hope that it finishes. I think there's no way it's gonna finish in the money, so I'm probably gonna have to sell it for a loss. And then Tilray, so Tilray has been good because what is it? Tilray has been good. It's risen a lot, and so I have 10 straddles on Tilray because the earnings report is coming out in January, and I also have the stock because I think it's gonna rise more. So that's basically the summary of my holdings. And don't really look at this that much because obviously I'm not going to sell any of my holdings if it's down. So I'm only going to sell if it gives me a net profit. And the allocation, so my stocks are down like 1,300. Not a lot, just down 3%. Mostly from BTE, because BTE dropped a lot, and then it sort of cancels out with the IVN because IVN rose 15%, but BTE dropped 16%. So it just the two of them kind of cancel out. And then WEED, so that dropped 30%, and then FM dropped 22%. Bitfarm dropped 16%, but it's very volatile, so it could rise back up in like one day. So just oh, and then HUT is actually an American stock. I don't know why I can buy it on the Canadian Stock Exchange, but it's American. So it dropped 23%. But it's very volatile, so it could rise 23% on the next trading day. And then, so most of the unrealized loss is from the option. So from the BTE cover call, so that's down 2,000. So, but as long as I don't buy back, it's fine. And then BlackBerry, because obviously it drops, so then the calls dropped in value. And then WEED, so for this, I don't think it's very accurate because obviously it can't possibly be worth 2,200. But anyway, so that I can just ignore that because it's not an accurate number. And Dollarama, so this is from the straddle on Dollarama, which I profited from, but obviously on the call leg it loses money. And then IVN, so this is the same as BT, so the stock rose, so then the call is worth more than I sold it for. So that's basically it. There's no real nothing mysterious about what these unrealized losses are. So now let's look at my gain loss. So let's see. Oh, this page isn't working. This page. Yeah, this page isn't working. I thought I could show you guys what. But yeah, it's not. It's not working. So I guess next week, if I have time, then I'll make another video where my gain loss is working. But I think it's up 3,000 or 4,000. I'm not sure. because obviously I only sell if I get a net profit. I never sell for a loss unless unless I'm forced to. So like, for example, if it's a option and it's about to expire, and then I have the choice of either holding it until it's worthless or sell it now for a loss. So that's the only case where I sell for a loss. If it's a stock, then I'm never gonna sell a stock for a loss. And if it's a covered call, I would never buy it back for a loss. I'm only gonna buy it back if it's worth, if it's cheaper than I sold it for. So anyways, now I'll just so these are the earnings reports for January. So Tilray, Aritzia, CCA, RCH, CLS, NG, RCI, MRU, GIB, MX. So yeah. So on these days, there should be a significant change. If the earnings report is, very different from the previous quarter. And then, so there's just one other thing. My laptop's really slow, so so basically this has been what I've been using, is not the actual options calculator, but it's something else on a bar chart. See if I can select it. Okay, so let's see if it shows. So I have to change it to Canadian. So basically I just look at what has the highest implied volatility. So this is actually new. NPK has a higher implied volatility now, so I think I'm going to buy NPK. Just give me a second. So before, HUT had the highest implied volatility, so that's why I bought HUT. And so you know that I know that HUT is going to have a significant price change because its volatility is the highest based on the bar chart. So, and then based on the puts and the calls, I can sort of figure out if the stock is going to go up or down. So in the case of HUT, so both the puts and the calls are high volatility. So that means that So that means that nobody really knows if HUT is going to go up in price or go down in price. So that's the main thing. I apologize for the lag. It's just okay. Let's see if I can open up Google Finance and then open up HUT. And again, I'm gonna put all the links in the description for, you know, the bar charts and for Google Finance and also for the earnings calendar. I think I already did that in my last video, but I'm gonna do that again. So if you look at HUT, so 1 day down 16%, and then 5 days is up 5%, 1 month is up 23%, 6 months is up 265%. So the short-term trend is hard to really tell, but I think in the long, so 1 year it's up 1,464%. So in the long run, anyone would bet that HUT is gonna go up. So but in the short term, it's hard to predict if it's gonna go up or down on the next trading day, which I think is gonna be January 3rd, because tomorrow, which is January 2nd, is not a trading day. Because today is, well, I'm not sure if it's trading day or not. It could be. I would have to search that up, but I'm not sure if tomorrow is a trading day. But anyway, so obviously HUT, at least last week, HUT was the most volatile stock, so that's why I bought it. And Tilray, I think, was second, so that's why I also bought Tilray. But let's look at what NPK is, because right now it is the highest volatility stock now. So it was up 28% on December 29, which is the last trading day, I think. Up 45% in 5 days, up 40% in 1 month. Oh, it's down 38% in 6 months. So it's sort of like a mixed picture about this, and this is a small cap, so it's a small cap stock, so I'm not sure if I would trade this because its market cap is less than 100 million, and usually I want to buy a stock with a market cap of at least $1 billion. So it's just let's see, obviously HUT, and then Bitfarm, Tilray, FM. These are all big stocks, large cap stocks, at least I think. I'm not sure. So if so for high volatility, at least if you think that the stock is going to go, actually it doesn't really matter if it goes up or down, as long as you can sell covered calls on the stock, because if the stock is high volatility, that means that the price will change a lot, either up or down, So that means that you can sell the covered call for the maximum price. And then if the price changes, then you can, if the price goes down, you can buy back the call option, and then sell another call option. So that's called rolling down. If the price goes up, then assuming, if the stock price goes up, assuming that if you sell the covered call at the money, that means that delta is 0.5, which means that you should sell, if you exit the covered call, meaning you buy back the call option and sell the stock, you will make a net profit. So whether or not it goes up or down, you will make a net profit. So yeah, for covered calls, and then for buying stocks, and for covered calls, you want to pick the highest volatility stock. That is just the most mathematically favorable. And then if you want to buy options, then you want the lowest volatility. And the reason for this is that the price of the option depends on the volatility, which means that the higher the volatility of the stock, the more expensive the options are. So obviously, the more expensive the options are, the more favorable it is if you sell the option. And then in the reverse, the lower the volatility, the cheaper the option is. So obviously, the cheaper the option is, the more favorable it is if I buy the option. So so if I want to buy options, then I want to buy the lowest volatility option. So lowest volatility option right now is for BNS, because the implied volatility is 7.08%, and the type is a call, which means that you expect, at least in the short term, BNS is going to go up in price. In the long term, it should also go up in price, because in the long term, all bank stocks go up in price. So it's just at least in theory, because all banks should. Well, if the bank stock goes down in price in the long term, that means that it's making bad investments. So I don't know, but I think in general, all bank stocks go up in price in the long term. At least for the big banks, like for example, TD, BMO, I don't know, CIBC, Bank of Nova Scotia, all the major banks. So so in 5 days, it's up $1.84. In 1 month, it's up $3.75. Okay, in 6 months, it's down. So let's see if 1 year. 1 year, it's down. But at least in the past month, it's been doing very well. And so it would be something that I would hold. So in the short term, so maybe when it goes up $1, then I would sell it. So I would probably still buy the 6 month, but yeah. So if it goes up $1, assume the delta is 0.67, then it goes up 0.67. So it's just, and if the bid ask, so if I buy at the ask 0.7, it goes up $1. So then it goes up 0.67, so it doubles in price. It's essentially the idea. So So the cheapest options are low volatility and short time frame. But short time frame is a little bit risky. So if I was gonna do this, I would buy 6 months, just in case the time frame's not good. But anyway, so just in terms of what options you would buy, you want to buy options with the lowest volatility and the trend. So you can find the trend. So it's a call, so that means it's going to go up. And then there's a bunch of other useful things that you can look at as well. But the other one that I look at a lot is the covered calls, obviously. And I don't know how long this video has been already. I don't want to record for longer than half an hour. So this is so this is the last thing that I'm going to explain. But covered calls usually, the most profitable covered calls are on the most volatile stocks. So I would assume it would also be for HUT. Yeah, it's all for HUT, because HUT is still, I guess, the most volatile. Yeah, HUT and then FM and then HUT and FM. So. And then based on the strike price, what it calculate the good strike price to be, then we can infer that HUT will rise in the future because the strike price is higher than the spot price. It's at 22, spot price is 17.68. So bid is 2.41. Oh, and this one's actually yeah, all the deltas are negative because you're selling the call, so it's the same as buying a put, except you earn the premium instead of paying the premium. So yeah, that's about it, because I don't want to make the video too long, so I'll put everything in the description. And so yeah, that's the end of this video.